it that way. And the Mutual brand, we think, really is, all things considered, the strongest one out there. And sometimes we got to remind ourselves that this is a product where we're expecting people to claim on this 30, 40, even 50 years from now, and the carrier really does matter. The other key differentiator, I think, in this product over most others is that cash benefit. And our feeling is that the average agent really undervalues what that cash benefit can do. It's so incredibly flexible, and it's just something that we think in the future, let alone the present, this is a product that will allow benefits to be paid where other plans simply won't pay them. And if you think about how quickly our world is changing, how the healthcare delivery system is changing, things that are available today are covered under a cash plan that just aren't covered under a traditional reimbursement style product. So I won't go into all the flexibility. Dave, you caught me a little bit off guard, I guess. But we just think it's a key thing, and we know in dealing with agents that this may not come off the right way, but you know, the average guy is simply a spreadsheeter. They'll look at a 4-year plan and compare it to another 4-year plan as though they're the same, and pick the lowest number as though it makes no difference. We believe it makes a huge difference, and we would encourage you guys not to do that. That if you're looking for real value, long-term value that'll hold up over the course of decades, which is what these plans need to do, you need to look closer at the cash benefit and what it will do for your clients. I'll pass it over to you, Dave.
Mike, you wanted to say something?
Yeah, I just want to kind of take what John said and go a little bit farther with it. One of the things that we've learned as an industry, and many of you have been with us for a long, long time along the way with regard to claims, is despite our efforts to push them away, our customers want to be involved in the process. They want their family to be involved in the process. And the cash benefit makes that work for them, okay? We know, having seen studies about percentage of care that takes place in the home, et cetera, that this is where they are gravitating towards. This benefit allows them to do that, to have the claim play out in the early stages of that progression of care. It plays out the way they want it to play out, and it makes resources that are available to them on day one for that to be the case. And then as the progression of care moves farther and farther, they transition back into the more traditional reimbursement phase, but this one doesn't put them in a position, the mutual product does not put them in a position where they have to pay out of pocket or significantly out of pocket to be able to stay at home and have the family involved.
Thanks, Mike. So basically what we're saying here is the MutualCare Solutions portfolio of products, and even the previous policy series with the Assure Solutions Gold, with that built-in cash benefit, does afford your client the most flexibility and control at the time in which they need it, when they actually claim. There are some other things that are covered in black and white in the contract that separate the mutual policy from others. Up here in the Northwest in Washington State, we have adult family homes, and in Oregon they have adult foster homes. These are assisted living type facilities, but they're in a smaller venue of, say, 5 to 6 adults max. They're a little more spendy than assisted living, but by far less than skilled nursing, and they're covered in black and white in the contract, which is kind of nice. So it's a lot of flexibility already in the black and white in the contract. But we have no idea what things are going to look like, as John mentioned, in the future. There's things being developed now that can enable people to stay at home longer. Pill boxes that send a signal to a doctor's office that you've mistaken a dose of meds. You know, sensors for your home and body that can sense a fall or keep an eye out for you. So, you know, this whole concept of granny pods, it's all there, and it's all coming down. And none of those things are in black and white yet, but cash will go a very long way to help cover those expenses in the future. So we just, honestly, we can't say enough about the benefits of having a hybrid product such as Mutual of Omaha. And then it's all about asset protection as well. You know, this whole concept of partnership came around in 2008. It was launched during 2008 and 2009 in most all states. The ability to protect your assets if you have a long-term care policy, exhaust the benefits, and then are doing the required spend down for state assistance, every dollar that the insurance policy paid out as far as the benefit is a dollar's worth of assets that are protected. But a unique thing to the mutual product is in a number of states, 3% is the minimum number that's approved for partnership. But in those states, given the flexibility of the mutual product where you can buy as little as 1%, you can actually buy yourself into partnership, whereas at some point in time, if you do meet the minimum threshold of that 3, you now have a partnership policy in that state. So pay attention to the rules as far as what different states have approved or not approved as far as partnership is concerned. In the majority of the states that have approved partnership, all the way down to 1% is approved, and no one else in the marketplace goes as low as we go or in the increments that we have with our inflation protection riders. We purposely worked with the company to come up with a scheme that allows you to start off at 1 and go up to 5 in 1/4 point increments. And each quarter point is plus or minus 6% savings or more money on premium. Going from 5 down to 3, which we think 3 is the new 5, is basically half the cost of buying 5% inflation. So that quarter point can equate to you making a sale or not making a sale. On a typical married couple, that could be $300 to $400 a year savings just by dropping it, say, from 3 to 2 3/4, or from 3.5 to 3 3.25. And then where it makes sense, you have the ability to cap the growth. So if you're working with clients in the mid-60s, you might want to consider capping the inflation after 20 years, give them good growth up until their expected claims age of mid-80s, and then it stops. And whenever you can cap a benefit, the actuaries relax a little bit because they know exactly what their financial exposure is going to be at claim time. Therefore, they can price the policy a lot more appropriately. So again, Mutual separates themselves from the pack as far as offering these different ways in which you can build a policy growth-wise. And keeping in mind that if you do start off with anything less than 5% compound, whether it be capped or lifetime, it has a guaranteed buy-up option, which means if you start off at 3 and you feel like 5 years from now, for example, 3 is not enough and you want to bump it to 4, you can do so on your policy anniversary with no additional underwriting to be had. You'll just pay an incremental attained age rate for that difference, that 1% add as an example. And those changes can be made as often as you wish on your policy anniversary for the first 20 years of owning the policy or up until age 75, whichever occurs first.
Dave, this is John. Let me say a couple things here. If you could go back. One of the things we're all dealing with is carriers continuing to increase premium rates. And what we haven't really done is change the point at which your customers, our customers, can afford coverage. So what we've done here with these inflation options is we've tried to create flexibility so that you guys can find the price where a given client can afford the coverage. So we were all sort of bread and buttered in the 5% compound, and it took a long time after we introduced prior policy concepts to get people to sell less than 5. And as Dave or Mike pointed out, the 3 is sort of the new 5. The reason for going lower and the reason for the guaranteed upgrade option is really to allow the agent to feel comfortable selling less. And the way we thought that would happen is by allowing the agent's customer to make a new decision later. Our feeling right now, this is a mantra we tell ourselves internally here, is that basically any plan is a good plan. That if somebody can't afford more than 1%, a 1% plan on $150,000 will go to $200,000 in 30 years. If that's all they can afford, then our feeling is that's a really, really good plan. And if they have the option to increase that 1% without evidence of insurability, anytime, as many times as they want, not to exceed 5, we think it makes sense. So the concepts here are really all about helping agents make sales, and we're doing that through maximum flexibility. So there's nothing else out there like this in the market that will allow you to go less than 3. There are some caps, but not the 10, 15, and 20-year caps that we put in there. And nobody has this guaranteed buy-up option, which is what makes the whole thing go.
Thanks, John. I appreciate that. In fact, a couple of different sayings we have going on around here is having something is better than having nothing. And then our newer saying is one is better than none. And what that means is if a person is thinking about not buying inflation at all, try to convince them to buy the 1%, because once they buy the 1%, they're in the game, and they can hang on to that inflation for the life of the policy, and they can grow it if they have to. But if they decide initially none, then they're locked out. So 1 is better than none. Keep that in mind. And these are just some spreadsheets that show you which states approve what as far as the different levels of partnership. All these rules are published in the quote software. There's a little green button right below where you select the inflation rider called Pick Inflation. And when you click that little button, it'll bring up the rules for the state in which you're doing a quote. So you don't need to have everything memorized as far as if you are doing business in multiple states. You'll find out immediately what's kosher and what is not appropriate for inflation protection for partnership in the state in which you're doing business.
Maybe just another comment on that, Dave. We've been doing some work with Harley Gordon, and many or most of you may know that name. But Harley shared some statistics recently on partnership benefits that have actually been paid. And the partnership programs have been out in some states for 20 years now. And the amount of benefits paid are basically infinitesimal. I mean, it really doesn't come into play that often. So, as we've been moving with these lower inflation options, some of the states have progressively moved with them and allowed for the lower options to be partnership approved. But again, our feeling is that if it's partnership approved or not, it really doesn't matter all that much. And we get that there's a sales side to this this thing, but in the real world, I think we all need to put it in perspective. And if a sales situation dictates that a non-partnership plan be sold, again, we think it's a good sale. There's nothing wrong with that.
All right, thanks, John. Yeah, I've got some statistics here I could share with you if you like, but I'll give you one example. California has been a partnership state for, many numbers of years, probably going back at least 20. And in California, there are 128,000 partnership policies currently in force. The total number of people that own partnership policies that ended up having to go down to Medi-Cal was 96. So that's a pretty small number when you think of how many people actually purchase partnership policies.
What's the percentage, Dave?
It's 0.006%.
Yeah.
It's a real small number. But thanks. I mean, so it's important to, obviously, going back to having something is better than having nothing at all. Partnership may be key or it may not. Remember, there's two ways to qualify for state assistance. Not only do you have to pass the asset test, but you also have to pass the income test. And with a lot of people's retirement streams right now, a majority of people may not ever qualify for any type of state assistance because of that income test. So keep that in mind as well. Now that we've had a full year of working with the new product, we've learned quite a bit. They made some underwriting changes, and we slowly have adapted and understand them better on a going forward basis. But just to give you a couple of tips here, this is around physicals and blood work. Those are two key things when it comes to Mutual of Omaha. Mutual still not doing parameds like other carriers have made a move to go to full parameds. Mutual still relies on phone interviews and face-to-face interviews given the age of your applicant. But physicals play a key role along with blood work. And when we mention blood work, it has to be what they call a complete metabolic panel, not a simple CBC. So for applicants that are under the age of 65, if they have not had a physical with complete blood work within the last 2 years, they're basically locked out of the preferred rate class. So if you have a client that hasn't had a physical, they go through underwriting, they get issued select, and you want to pursue trying to get that additional 15% discount, you've got 60 days from when that policy was issued for them to go out and have a physical with blood work, get the results back into the underwriter, and they will they will consider re-rating that applicant based upon the results of the physical and the blood work. 65 years old and older, it's the very first question on the application. It's a knockout question. If they have not had a physical with blood work within the last 2 years, they cannot even apply for coverage. So keep those thoughts in mind. And also there's a rule around if you're thinking about what we call front-loading a policy, where you're going to overinflate the initial benefit and let it ride without inflation, there are some numbers to keep in mind there as far as what you can apply for, again, without having a physical with blood work. A little bit of family history is now being underwritten by Mutual. Other carriers are doing so as well, mainly around dementia. If you have an immediate relative who's been diagnosed with the onset of dementia or Alzheimer's, you'll have a policy limit of 5 years. That's the only limitation. There's no restriction on the inflation or the monthly benefit at all. So these are little underwriting tips we've picked up along the way. We thought we'd share with you up front so that there's no surprises for you back in the back end. Mutual is ordering medical records on every applicant, which actually in one way is a positive because it has expedited the underwriting process probably by a good 3 to 4 weeks, as opposed to waiting for the results of the phone interview or the face-to-face to come in, and then the underwriter makes a determination if they want to see medical records. They already have them in-house, so we're seeing by far a faster turnaround. Mutual has reacted to the marketplace too administratively to make your lives easier and better as well. They recently have implemented a new program involving case managers who basically take a case coming in the door all the way from receiving it to the policy going out, complete ownership, single point of contact. That's knocked anywhere from probably a week to 2 weeks off the underwriting process alone, as opposed to having 10 people touch up an application. Now we only have 1, and they're basically the team leader as far as directing how the rest of the company works as a result of an application hitting the door. So real big positive that Mutual is on your side, recognizing that you want to get business through quickly, in place quickly, so you get paid quickly. Okay, as a way of wrapping things up, just want to give you a little bit of contact information here. You can always feel free to call us for hard copy supplies, but if you're working on a weekend, realize you haven't got an application for your state and you have a 6 o'clock Saturday evening appointment, you can go to our website, the yaim.com website, log in, and go to the supplies part of the website and pull yourself down an application, which is a fillable PDF. So that's available to you 24/7. Otherwise, if we're open from 6 a.m. to 5 p.m. Pacific, Monday through Friday, feel free to give us a call. We'll get supplies headed your way right away. And then again, you also have the ability to call and pre-screen your clients with us, or you can also get direct access to an underwriter at the home office. They're open from 8:30 to 4:30 Central Time. And when you do call in the hotline, you will be hooked up with an underwriter that kind of share the duty throughout the day. So you know you're getting the right information right from the horse's mouth. If you haven't already downloaded the quote software for the new product, you can do so by going to this page on our website, the yaim.com/software. You'll be prompted to type in your name, your email address, and your resident state. That's just for tracking purposes. And you'll be grabbing, there's 3 pieces of software up there: the old Assured quote from the product back in 2006, the United of Omaha quote software for the old Assured Solutions Gold product, and the new one is called MutualCare Solutions. It's a blue icon. So it'll be in a blue Indian head Mutual of Omaha icon on your desktop once you have successfully downloaded it. A new feature we put into the new software is that every time you open it, it does a handshake with the mothership, and it will let you know immediately if your software is current or out of date. And if it is out of date, there'll be a process shown to you on how you achieve updating your software. All right, Mike, do me a favor. You start at the top, but I'll start at the bottom. We'll go through and we'll start unmuting people, and we'll open it up to the field for questions. If you happen to have us on a speakerphone, please make sure you're muted. Mute your speakerphone or dial *6 to mute yourself so we don't have any background noise.
唔係肌肉啊！哎呀，死我個麵包喎！
All right, we figure out who that is yet, Mike? Okay.
Yeah, I got it.
Okay. All right, we're getting everybody unmuted. Does anybody have any questions out there of either Mike, myself, or John?
Yeah, Dave, I can have a question for you.
Go ahead.
The question is, you just talked about this new mutual product that's been out for the last year, and you just referred to some of the older software. Are the Assured Solutions Gold products still available in some states?
Yeah, the Gold product is still running in Montana, Hawaii, and New York.
Got it. Okay.
And the Assured Quote software is up there because, I don't know if you remember or not, there was a rate increase on that product here a little while ago.
Right.
And we enhanced that software where you can key in what a person bought at the age they bought it. It will display what the premium was when they bought it versus what it is with the rate increase. So you can manipulate the benefits to potentially downgrade some of the benefits to help mitigate the rate increase.
Okay. Thank you.
You're welcome.
I have a question.
Yes.
You said if there's like a family history of dementia, that there's a limit of 5 years. Was that limit of 5 years, is that how long they could be, get assistance or what?
The 5-year policy limit, correct.
5-year policy limit, okay.
With the MutualCare custom product, you can actually build a policy that has a little over 8-year plan duration. The minimum is 2. So if you apply for an 8-year plan, for example, and there is that family history, the underwriter will come back and basically submit you an offer that the policy would pay out for a total of 60 months.
Okay.
We almost never sell plans of those lengths anymore. We're seeing mostly 3s and 4s.
Yeah,
Okay.
better than
Doesn't come into play much.
Exactly.
Question for you. So they did not limit the monthly or daily benefit, though, so you can buy up the benefits, and then ultimately, if you use less, the duration of the coverage could conceivably go beyond the 5 years based on use?
Correct. They always base it on the initial calculation. Obviously, if you buy a $8,000 monthly benefit, you'll be restricted to the 8,000 times the number of months. Well, the months max would be 60. That would have your policy limit. But if you're only incurring expenses of $4,000 a month, the policy will pay out longer than 5 years.
Oh, okay. So if you weren't using the amount you had, then you're okay.
Correct.
Correct.
Oh, okay.
All good questions, by the way. Okay, hopefully you all joined us early enough where you saw the various promotions that we and or Mutual have going on. We have a fantastic lead program that we've negotiated a discount with Target Leads. Target Leads has teamed up with the 3 and 4 campaign to develop a 3 and 4 long-term care mailing that they're seeing north of 1% return, which is unheard of.
I missed that particular slide that you're talking about.
Okay, Mike just grabbed it. You should.
It's on the screen right now.
Should be on the screen right now through Target Leads. We've got a discount. Agents who work with us automatically get an $85 discount off the rack rate for Target Leads. And then Target, as I mentioned, has an exclusive deal cooking with the 3 and 4 Need More campaign for a mailer specifically about that is enjoying a significantly higher rate of return than traditional long-term care mail in the past, too. Mutual of Omaha has a few different programs cooking themselves around Medicare supplements. They have an incentive trip. In Oregon, they just launched a new product, our new company. So they have a program for cash with apps. You've got marketing credits to be achieved with selling Mutual of Omaha Medicare supplements. We have a fantastic program going ourselves here at AIM with a TV giveaway program based upon production between now and the end of the year, up through and including an 80-inch curved Samsung high-definition TV, all realistic goals to achieve. So we're excited about the opportunity to give away mini TVs to a lot of you out there. If you need more details around any of these various programs, call either Mike or I afterwards or pop us an email. And we'd be happy to share with you more details around these programs.
Let me add a point to the LEAD program. Not only have we negotiated discounted rates, these are the best rates you'll find anywhere, is we will reimburse you based upon production coming off any direct mail campaigns that you're involved with. We'll reimburse you $100 an app for long-term care.
Thanks, John. In fact, our feeling here is if you're willing to make an investment in your practice, then we're willing to make an investment in your practice as well. So. Good. Any other questions out there?
Yeah, do we have to be a member of 3 and 4 in order to get this service?
You do not need to be a member of 3 and 4 to take advantage of the 3 and 4 Need More campaign with Target Leads. Obviously, 3 and 4 Need More would love to have you as a member of the program. I believe the annual membership is $60 for that, but you don't need to be a member to take advantage of the LEAD program.
So
Thank you.
I'm not exactly sure what y'all were just now talking about. So to be a member of, is it AIM that you're talking about, or what's 3 and 4?
Oh, 3 and 4 is a national campaign that was put together 3 or 4 years ago. It's all around the fact that 70% of people over the age of 65 are going to need some form of long-term care help. So there's a non-for-profit group that was formed called the 3 and 4 Need More campaign. And they've developed a lot of different marketing materials. They're out there in the press all the time. And that's why Target Leads is taking advantage of that notoriety of the 3 and 4 Need More campaign and have developed a whole lead system around it for direct mail. And as a result, they're achieving stronger than thought of returns on that campaign. You can Google 3 and 4 Need More. Yeah.
Go ahead, Dave.
John, I'm sorry, John, I didn't mean to cut you off. Yeah, we have information here we can send you on the campaign. You can Google 3 and 4 Need More, and they'll take you right to their website as well, and you can learn more. And I think you could even join right on their website if you'd like to.
Oh, okay.
There are a number of tools available by becoming a member that will help brand you as an LTC specialist.
Okay. So you can go on 3 and 4 website and sign up with that, and that would get us through this the AIM price.
No, they're different things. So the 3 and 4 membership will, like I just said, it will make available to you a number of different tools that will help brand you as an LTC expert in your area.
Okay. Okay.
To take advantage of the Target Leads program, all you need to do is contact us or contact Target Leads. Let them know that you're working with AIM, and you'll get the discounted price. And then they send reports to us, so we'll be able to monitor your production, and based upon your production, we'll be able to credit you back your lead costs, depending on how much you do.
Okay, sounds good. Thank you.
Yeah.
Hey, this is Mike from Colorado again.
Yes.
I wanted to expand on that question, or what you mentioned about AIM contributing towards our lead costs. So if we sign up for a lead program in our area and we contribute $400 or $500, whatever it's going to end up being for that lead program, and out of the results of those leads, then we submit 3 applications that get issued back to AIM through Mutual, then AIM is going to reimburse us $100 for every issued long-term care case?
That's correct.
That's great.
And maybe just to complete the topic, the way the discount works is it's $100 for a long-term care app, it's $75 for a critical illness app, $50 for a final expense app, and $25 for a Medicare supplement app.
That's great.
They have different, Target Leads has different lead programs for different product categories.
Okay. That's great.
Yeah, like I mentioned, if you're willing to make an investment in your own practice, then we're willing to make an investment in your practice as well. So we're pretty excited about this new program.
And that lead per application reimbursement doesn't really matter which carrier it is through AIM?
No, it does not.
I mean, obviously, if our client chooses a specific carrier through AIM, as long as we bring the app in and it gets issued, then the reimbursement takes place.
That's correct.
That's a correct statement.
That's great.
The TV program is restricted to Mutual of Omaha only.
Right.
Okay. Any other thoughts or questions out there? Okay, if not, again, thank you everybody for your interactive webinar today. We do appreciate you bringing up the questions at the end. Thought they were all good. And the session, go ahead.
Just one more thought on the lead, since there are a number of questions on that. Dave, you mentioned north of 1% on the long-term care. We have some people that are north of 2.6% on their Medicare supplement leads. And another gentleman did a final expense, 2 mailings. One of them was almost 4. The other one was 2.5 or something like that. So target leads has been getting pretty good results. If you've worked lead programs, you know that they're not all gold. You got to sift through some people that are unhealthy, or sometimes you run into people that don't have any money, or the various things you run into with direct mail leads. But we've been getting real good results, and these guys have been around a long time. And, I think in terms of price and the reimbursement opportunity, it's really a good option for you.
Thanks, John. Appreciate that. All right, with that, hope everybody has a great weekend. Again, thanks again for joining John, Mike, and myself on a Friday morning. Hope you have a very successful week next week, and we'll look forward to talking with you soon. Take care.
Thank you.
Thank you.